Hi, welcome to a quick video on the conversion of cash basis to accrual basis. This is a fairly common requirement if you work for a small CPA firm or a small accounting services firm. We do this for a lot of small companies. Let's look at an example. SK Lawn Service Company maintains its books on a cash basis. In other words, they basically use the checkbook. However, the company recently borrowed $50,000 from a local bank, and the bank requires SK to provide annual financial statements prepared on an accrual basis. During 2024, the following cash flows were recorded in the checkbook. Cash collected for service to customers was $240,000. Cash paid for salaries was $90,000, supplies was $12,000, gasoline was $9,000, rent was $6,000, insurance was $1,200, and miscellaneous, we paid miscellaneous expenses totaling $5,000. Thus, the total cash paid for expenses was $123,200, and the net cash provided by the company was $116,800 for the year. Cash basis net income. Okay. Now, if you go on to read further, you are able to determine the following information about accounts receivable, prepaid expenses, accrued liabilities, and any other relevant accounts from examinations of records and follow-up discussions with the proprietor. And so what we have here is the balances you determined at the end of the last 2 years. So it's currently 12/31/24, and this was what the balances were in these important accounts at the end of 2023. Okay, so for accounts receivable, customers owed us $10,000 at the beginning of the year for sales not yet paid from fiscal 2023. And at the end of this year, they owed us $15,000 for services we rendered in 2024. Prepaid insurance, the insurance premium is $1,200 per year, payable on May 1. Thus, if we make the payment on May 1, the prepaid insurance account, that's $100 a month, and there's 4 more months in the policy, January, February, March, and April. So we had prepaid insurance at the end of every year of $400, where we were still going to be insured for another third of the year. Cost of supplies on hand. The cost of supplies on hand at the beginning of this year, the end of last year, was $1,000. The cost of supplies on hand this year was $500 at the end of the year. Salaries earned but not yet paid were $500 at the beginning of the year. In other words, that's what was earned but not yet paid from at the end of 2023. And at the end of 2024, that amount is $700 earned but not yet paid. Prepaid rent is $500 each year because we have to pay our rent on the 30th of the previous month. So in each year, we had prepaid rent of $500. Okay. In addition, from talking to the owner, you learn that the bank loan dated October 1, 2024, it was dated October 1, 2024. That's when we took out the loan. And the principal and interest is, the interest on it is 10% in 1 year. They're due in 1 year, both the principal and the interest. So on October 1, 2025, we must give the bank $55,000. Depreciation on the company's equipment is $10,000 for the year. So required here is prepare an accrual-based income statement for 2024, ignoring income taxes. All right, let's do that. Keep that information handy. And what I've done here is I've summarized all the information we just looked at. There's cash collected from customers, and then cash paid. So that was on the information given to you on the Word document, the assignment document. Now, I went ahead and took the information on that on the second half of that of the assignment, the case, and I basically made what the balance sheet accounts would look like. So accounts receivable was $10,000 at the beginning of the year, $15,000 at the end of the year. In other words, $10,000 at the end of last year, $15,000 at the end of this year. Prepaid insurance was $0 at the end of last year. That's not correct. It was $400. I apologize. And it is $400 at the end of this year. Cash on cost of supplies on hand, $1,000 at the beginning of the year, $50 at the end of the year, and so on. And notice I put accumulated depreciation. I went ahead and put in $26,000 and $36,000. The key being that it went up by $10,000 for that depreciation. And then prepaid rent. I made up the beginning balance just to make it not be 0 to 10, which it certainly could have been if we had just started the company. Prepaid rent of $500 at the end of each month. Okay. And let's now do the solution. Oh, and by the way, of course, as always, why don't you take a look back at your notes from your reading and give this a try. And I will see you when you've given it a good try. It's an important skill. Okay, welcome back. Okay, the book provides a neat process for making these determinations, cash to accrual basis. I'm going to show you that method, and I'll also show you the logic underlying the method. So with revenue, what we're going to do in each case is we're going to make the journal entry, the sum of the journal entries associated with that item. So when we made sales, we debit cash and we credit sales revenue. All right? Sometimes we debit receivables, though. Sometimes we debit cash. So you have a debit of cash for $240,000 total. Well, I know that because that was up here above. We looked in the checkbook and determined that's how much cash we were paid during the year. But sometimes that was cash for the accounts receivable, and sometimes it was cash for sales. So that's the next thing. The accounts receivable balance is also potentially impacted. So let's say that the change in accounts receivable was a $5,000 debit. It increased. It went from $10,000 to $15,000. And to do that, there was a net debit of $5,000. And therefore, the net credit to sales when cash is the net credit to sales this year is $245,000. Okay, so that'll be sales revenue. Let me also provide some logic to this. The cash was $240,000. Cash collected okay, but we want sales. So we have to add the $15,000 for sales that we made but this year but didn't yet collect the cash on. But then we have to take out the $10,000 of cash collected, but the sales were recorded and those were 2023 sales and we just collected the cash. How do I know that? That was the beginning balance in the receivables. So sales is $245,000, even though cash collected was $240,000. Okay, and that's the logic. So this is that's the logic for this. That's a simplified method where you don't have to think as much. You're welcome to do it either way or both. Let's go on to the expenses now. Salaries expense. Well, the cash paid for salaries was $90,000. So we'll be crediting cash for $90,000. The change in salaries payable was plus $200, and that's a credit. So there's the cash paid of $90,000. There's the credit to change in payable, but because it increased from $500 to $700 during the year, and so salary expense is $90,200. Sorry. The debit to the expense is the $90,000 of cash paid for salaries plus the $200 increase. Put differently, cash paid was $90,000 plus the $700 of salaries earned but not yet paid, and then minus the $500 of salaries paid this year but earned by the employees last year. Therefore, salaries expense is $90,200, even though cash paid is $90,000. All right. What we do next? Let's do supplies next. Supplies expense. Okay. We paid $12,000 for supplies, we see in our checkbook. Then when we went and thought about what's still on hand at the end of the year, supplies on hand, there was $1,000 of supplies at the beginning in the cabinets, but there's $500 of supplies at the end of the year. Thus, of the supplies we used, $500 $1,000 we paid for last year, and then $500 we paid for this year, but we have not used them. All right. So the cash is the $12,000 credit. The change in supplies inventory is a plus $200, which is a debit. I'm sorry, it's a minus $500, so it's a credit. Sorry about that. And so supplies expense is $12,500. Again, put differently, cash paid for the supplies was $12,000. But the cash supplies on hand were 1,000. So plus 500, or I'm sorry, plus 1,000 for supplies we used that were on hand at the beginning of the year, and then minus 500, which is the cash paid this year, but we haven't used them yet, so they're still an asset. So supplies expense is 12,500, and that's when we use the simplified method, that's the debit. Okay, so the cash paid. Now we're reconciling to supplies expense. We're discerning supplies expense. Well, the cash paid was 12,000, but from that, we used the 1,000 we had at the beginning of the year, but did not use the 500 yet that we've paid for, but they're still on hand. So the expense, the used up supplies, is 12,500. Next item is rent expense. Okay, rent expense, well, prepaid rent began the year at 500 and ended the year at 500, so there's no change in the rent the prepaid rent. We paid 6,000, so we have a cash credit, no change in prepaid rent, and therefore rent expense is 6,000, just like the cash. Said differently, cash paid for rent is 6,000 plus the 500 that we paid for in 2023, but it's 2024 rent, but then minus the 500 that we paid for at the end of 2024, but it's still an asset because we get to use the building in 2025 for a month. So that rent expense is 6,000. All right. Next item is insurance expense. So cash paid for insurance was 1,200. Remember that? So that's the credit to cash. The change in prepaid insurance was 0. It was 400 in each year. And then insurance expense is the same, 1,200. So the logic is going to be the same as the one above. The cash paid was 1,200. That's 100 a month for 12 months. But we pay it a little early. We pay it when the premium is due, which is May 1. So on May 1, 2024, we actually paid 100 a month that'll still be there for prepaid insurance, the 400 that'll still be there for January, February, March, and April's $100 rent. So rent is 1,200 plus the 400 that was paid for in 2023, for January, February, March, and April of 2024, but then minus the 400, which we paid for in 2024, but it's for January, February, March, and April of 2025. And so therefore, insurance expense is $1,200. Interest expense, well, the interest paid is 0, but interest payable would be $1,250. 50,000 multiplied by the 10%, or 5,000 a year, times 1/4 of a year is 1,250. So that's accruing for October, November, December, and October, November, and December of 2024, when we use the bank's money for those 3 months, but have not paid them interest yet. So now we owe the bank, as of 12/31/24, the 50,000 principal plus the accrued interest of 1,250, which will work its way up to 5,000 by the time we pay them back in at the end of September of next year. And then depreciation expense. So we don't pay any cash for depreciation expense. That cash was paid out when we bought the equipment we're now expensing. So cash paid is 0, but accumulated depreciation was credited for 10,000 net change. I said it went from 26 to 36. That wasn't given in the facts, but I just made numbers up so that you can see that that's how it would work. And then therefore depreciation expense is 10,000, even though cash was 0. So here, for both of these, cash paid for interest is 0, but plus the 1,250 accrued, and then we didn't pay anything for stuff accrued in the 2023, so interest expense is $1,250. Similarly, cash paid for depreciation is 0, but the increase in accumulated depreciation is 10,000, and so the depreciation expense is 10,000. And that's it. Now, let's talk a little bit about what all this means. First, here is both of the statements for you. There's the cash basis income statement, and there's the accrual basis income statement. And it comes to $109,850 is net income, whereas net operating cash flows were plus $116,800, with the big difference being that depreciation, the cash out happened in some previous year. Okay, and that's cash to accrual. Now, important skill, practice it. Practice it a lot. You have a case in your homework, and then you're also, please reprint this one and then work it without reference to my video. Hopefully you already did that. And I'll give you a little hint. You remember when I said that given the balance sheet and the income statement, I could do the statement of cash flows? Well, this is how. It's the exact other side. When you give me the income statement, I know the expense. And when you give me the balance sheet, I know the change in the related payable or receivable. Therefore, I know the cash paid for any particular item in the same method. It's the same thing. It's just the inverse. And so with big companies, we're going to have the balance sheet and the income statement like we did in our case, and then we can produce the statement of cash flows from that in the same way, inferring net cash debit or credit from the cash paid, from the expense, and the change in the balance sheet account. Okay, so that's a little preview to something you're going to apply very thoroughly in financial accounting and reporting too when you prepare the statement of cash flows in full form rather than the simplistic introduction we did in this course. All right. Thank you for your attention. Important topic again, and have a wonderful day.